This particular panel is not going to be moderated by me, and I'm very happy to hand over the reins to Improved, the hosts of this panel, and Daniel Lyons, Managing Director at Improved. Where are you? Here you are. Come on up. Let's have a warm round of applause for Daniel, who will take over and moderate this panel. Good to see you. Hi.
Good afternoon. Good afternoon, everybody. It's great to be here and to see so many familiar faces. I'd like to start by thanking the ICNC for pulling together the ecosystem once again and having everyone in the same place at the same time. It's really a great opportunity for networking and to see everybody. So thank you to the organizers. As you've just heard, my name is Daniel Lyons, and I'm at Improved Corporate Finance. But until earlier this year, I was in charge of M&A and investments at Shell. And for the last 3 years, I looked after all of the activity in that space for the global oil company. It meant that I was fortunate enough to meet and hear from hundreds of entrepreneurs and leaders developing solutions and new business models in e-mobility. In my time at Shell, I oversaw investments, JVs, and acquisitions in businesses from Envoy and Revel in the United States to NWG Charging and Ubertricity right here in Germany. I recently made the transition from being on the buy side, on the investing side of transactions, to the so-called sell side, and joined Improved Corporate Finance based out of their London office back in June. So who are Improved Corporate Finance? This is the bit I get to do at the start, right? So as a boutique corporate finance advisory firm, we help our entrepreneurial clients raise capital to fuel their business, as well as support the entire M&A process. In a world of generalist advisors, our key point of differentiation and what makes Improved really stand out is our deep sector understanding and expertise, as well as our cultural alignment with entrepreneurial innovators. We have a long-standing reach into the investor community, both on the financial and the strategic side. And as a result, we have become the market leader in e-mobility and EV charging, and have been advisors on some of the biggest deals in this space in recent years. Oh, sorry, the slide's not kept up. There you go. Here is just an example, or some of the deals that Improved has worked on in the last couple of years. As you can see, this experience has spanned the full EV charging value chain, and we've worked with everyone from public charging or asset-heavy operators to makers of charging hardware and infrastructure equipment, to providers of CPMS or EMP software, as well as businesses offering energy solutions related to e-mobility. A few of our recently announced deals include the $185 million sale of US charging hardware company Rhombus to the automotive supply chain player BorgWarner, the $75 million sale of plug surfing to FleetCor, announced just in the last couple of weeks, and the $150 million investment into PowerDot by Ontin, the infrastructure fund. And that's just a few examples. As a result of this track record, we have the most up-to-date and detailed understanding of which investors are active, what they're interested in, and how they're valuing the sector. The investment I just mentioned by Ontin is part of an interesting development that is seeing more and more activity and interest from infrastructure funds, asset managers, and private equity investors into the e-mobility and EV charging space. On this slide, you can see a selection of some of the most significant investments made by infrastructure funds around the world in just the last 18 months or so. The shading is the deals advised on by the team at Improved Corporate Finance. I think what is most notable about this picture is it's not just the frequency of these deals that is picking up pace, but also the size of the checks being cut is also accelerating rapidly. Which brings us on to the topic that we're going to cover in the next hour or so, and the key questions that we will explore together. Is EV charging infrastructure evolving as an asset class? I think everybody in the room here today can agree that we've moved beyond the initial phase of investment, labeled here as early adopters, during which a mix of venture capital, strategic corporate investments, and government funding provided the seed capital or the necessary capital for the first wave of charging infrastructure or associated services. But as EV adoption has steadily grown, and although we're still at the very early stages of that, it's definitely grown, so too has charge point utilization, which has made charging infrastructure increasingly more attractive for a different class of investor. So much so that, to my previous slide, we're seeing growing interest from infrastructure funds and real asset funds, funds that would typically be much more comfortable deploying their capital into assets that deliver low risk, steady, and predictable income streams. So does this mean we've turned a corner? Is this a trend that is set to continue, or is this just a few funds dipping their toe into the water? To help explore this topic, I'm privileged to be joined by a very esteemed and distinguished panel of speakers that spans operators, advisors, and investors. We have Christian Wagener, who's partner and managing director at Boston Consulting Group. Christian has extensive experience leading strategy development and the transformation programs across the value chain for industrial and energy companies. He has a deep interest in decarbonization and electrification and is one of BCG's experts on sustainable mobility. We have Luís Santiago Pinto. He's the CEO and co-founder of PowerDot, one of the fastest growing owner-operators of charging points of electric vehicles in Europe. As just mentioned a minute ago, Luís recently welcomed a large investment from an infrastructure fund. Prior to founding PowerDot, Luís was active in leadership roles at both Uber and Lyons, so no newbie to this sector. We have Wolfgang Brand, who's the CFO at Commercial Vehicle Charging Europe, a joint venture between Daimler Trucks, Traton, and the Volvo Group that plans to build and operate high-powered charging points on key routes for, you guessed it, the commercial vehicle segment. An expert in capital markets and corporate finance, Wolfgang was most recently CFO of Orkan Energy, a private equity-backed green tech scale-up. And last, but certainly not least, we have Witold Marais, who's the investment director at Mirova. Witold leads investments in low-carbon mobility for their latest $1.6 billion Euro Transition Infrastructure Fund. He has made numerous transactions in EV charging, e-mobility, infrastructure as a service, hydrogen and mobility. So please join me in welcoming our panelists to the stage. So welcome, everybody. A lot of speakers today have talked about reaching a tipping point in EV adoption. If this is truly the case, what do you think that means for the financing of EV charging infrastructure in general? And Christian, why don't we start with you?
Yeah, thank you. There was a lot of talk about parents. So my father actually just bought an EV just recently, and I think it's a sign for, that people are not questioning the if anymore. And I think that's what we see in the work with investors as well. I think there's a lot of education needed for investors coming into this space sort of as newbies. But then the if of penetration is not a topic anymore. And in addition, I think there's also now a little bit of a sort of more of a momentum for the question, let us not miss the boat here as investor. Sort of how do we best make sure that we can participate in this fantastic growth opportunity that the ecosystem provides?
Yeah, great. Thank you, Christian. And maybe Witold, as an infrastructure investor, what do you think the tipping point in EV adoption could mean for investments into this space?
So I tend to agree with the tipping point, although if we look back at your curve, I think we are still in an early phase of the market. There remain a lot of uncertainties, not the if, but the when, the where, the how EV drivers will want to charge. And so you have to build convictions that can be proven wrong fairly quickly, so it doesn't make things easy. But how does that tipping point materialize on the financing side? So first, and I think that's a good indicator, if you look at all your deal list, is the entry of infrastructure investor, who tend to be more risk adverse than venture capital. So this is a first indicator that infra funds who tend to have more conservative investment approach do fund EV charging companies and CPOs. Then you also start to see senior debt. And that's really material. It's not negligible, like senior debt will be the enabler because it will free up additional capital that will fund itself more networks. So the fact that senior lenders finance asset costs on a traffic risk model prove that the risk start to be a bit more understood and that investors can approach them in a better way. And so what's the consequence of that is that more capital is available for EV charging companies, especially CPOs. But it can also have a side effect. It will trigger a race to critical size. It can also trigger the appetite for aggressive customer acquisition strategies and deployment. And so I think we need to strike the right balance between fast-paced development, but also performance-driven growth. And this is probably where infrastructure investors will be quite cautious about. It's what growth are you funding? Is it just acquisition of market share and deploying charging points here and now wherever it makes sense? Or if you are really looking at your unit performance?
Thank you. So we've heard from our advisors here and investors that there is going to be a lot more capital invested into this space. It might come with different conditions or there might be different focus in terms of the risk profile. So let me now turn to our two operators into this space. I'll start with you, Luís, if I may. Where do you see this new capital being deployed first? Do you think it's going to go more into residential, as we've seen so far, more into public, more into commercial? What's your view on that space?
Well, I think that the good thing about our technology and about the EV charging technology is that we can install chargers basically everywhere. And of course that charging at home is very efficient for an EV owner. But if you live in an urban center, most likely you won't have the chance to charge at home. So public infrastructure is kind of very important to increase the confidence of EV users or new EV users to buy an EV when buying a new vehicle. And I see a world where we're going to have an EV charger basically everywhere we park our cars. And this will be a combination between home, office, and public charging infrastructure. So it's not going to be a winner-takes-it-all kind of market. It's going to be different places where we will be able to charge. And this will allow us to provide the best user experience for the new EV users to come.
Okay, great. Thank you, Luís. And maybe now to you, Wolfgang. In a relatively new business, I've heard described a couple of times today as the Ionity for commercial vehicle charging. What's your view on the deployment of capital into EV charging?
Well, first of all, I would completely agree that, I've heard that we've come to that inflection point of this morning was called the point of no return. And I think that's correct, but still there is a lot of money that needs to be still invested in making it really a good user experience, and that's more on the private side. So I fully agree with the assessment that it's about a charging point and it's about the experience. And it doesn't matter if it's private charging, if it's in a public area. The user just needs to understand that it's the easiest and most convenient thing for him, and it just disappears. It's just there, and you can charge everywhere. Now coming to the commercial industry, where I think is going to be the next big thing, obviously because that's the industry that I'm in now. It has to be to a certain extent because that's the next big industry. It's a trucking industry, specifically the long distance and heavy duty trucking industry that needs to be electrified for a simple reason, because there's the biggest impact on the decarbonization, and this is the reason why we are doing this, right? you know, we can learn a lot from electrification in the private sector, but then still it's going to be a bit of a different play. You know, we're talking about different sizes. We're talking about, you know, larger stations. Even on the technology side, the existing charging technology needs to be further developed. We need to be quicker because in trucking and long distance traffic, there's a different use case. So yes, there has to be a lot of money that needs to be invested to come up with that infrastructure. And I think in the trucking industry, we will be a bit back into more the venture and strategic investor side because there's a couple of more risks. However, I think if you take a look at the environment, if you take a look at, you know, the fact that there's not like 30, 40, 50 OEMs, but it's a handful of really OEMs that make a difference. And the customers, there's a couple of large logistic companies out there, and they all are desperate to get into that market. They want it. So infrastructure is kind of a bit the missing piece now to bring these things together, and therefore we are rather optimistic that, you know, we will find capital to support that and get the next big wave rolling.
Very good. And let me also take this opportunity to remind everybody in the audience that you can also submit your questions using the app for the conference, and so we will have plenty of time shortly to address questions from the audience as well. So we've talked already a little bit about the fact that there is going to be continued influx of capital into this space, and it's changing slightly in its nature and who the investors are. Let me go back to Witold from the infrastructure side and just ask you this. What's the most interesting business model for an infrastructure investor in EV charging? Is it asset-heavy ownership? Is it asset-light business models? Is it aggregation? What's the most interesting for you and maybe why?
So first, I think it's quite hard to answer for all infra funds because they will position themselves on a spectrum with various degree of appetite for some type of risk, and we can deep dive into them. But generally speaking, infra funds like a couple of things. They like long-term. They like capex intensity, and if we look at the top line, they like predictability, stability, recurrence, however you call it. And to that extent, I think the asset ownership model is the most obvious play for them. It doesn't mean that some of them may not decide to invest somewhere else, but at least this is an obvious play. They like capex intensity because to a certain extent it creates barriers to entry. We can argue when there's a lot of capital whether this is a strong barrier or not, but at least it's a barrier. They like capex intensity as well because it leads to high equity requirement, which usually match their size and investment strategy. They like the long-term part of the CPO business model because you have two elements in the CPO business model that give this long-term horizon possible. First, the asset life of the equipment itself. When you invest in a charger, it has a 7 or 8 year asset life, so at least you can work around it and try to make some revenue over that period of time. And if you revamp it, if you change some part of the components, you can extend it to maybe 15 years. And also the lane leases. When you install your charger, you can negotiate lane leases for 15, 20, many more years. And so that gives you really a long investment horizon. And that's the first thing. Then on the other side of the spectrum, you have the full asset-light model, which are usually a bit more difficult to grasp for infrastructure investors. When you don't have a tangible asset base, usually, put simply, your value lies in your market share, in your customer base, in your sales force, whatsoever. And to them, it may appear a bit weaker barriers to entry, bit right or wrong, I don't know. And then in the middle, the boundaries are a bit more blurry. And especially you have a lot of CPOs who are also EMSPs. And so they are incorporating also some business lines from software licensing, etc. So they're trying to develop also asset-light revenue source. So, and all of this is moving constantly. So it's quite difficult to have a definitive answer, but this is roughly what I would say.
No, that's great. I think we're hearing that consistently across the market, that it's still very new, and there are still new business models being developed all the time. I think we'll come back to that point in a minute around adjacent revenue streams and so forth. Maybe we'll hear from you, Luís, and you, Witold, sorry, Wolfgang. But so from an infrastructure side of things, and I appreciate you're not speaking on behalf of every infrastructure investor in the room. It's all about long-term and predictable income streams, and EV charging is certainly moving into that space. Maybe, Christian, from your vantage point as an advisor to all types of investors, not just infrastructure investors, but growth equity, private equity, what are you seeing from your perspective as what is most attractive, or what are investors really looking for as EV charging evolves?
I guess sort of very much in line with what you said. Of course, sort of let's say the core plus, and then increasingly also core sort of infrastructure players are, looking at the asset-heavy, businesses to deploy a lot of capital, great sort of risk profile, at least in the long term. But I guess it's fair to say that what they're investing in right now, right, is typically a management team with a pipeline and a couple of chargers, right? And I think that's so I think to get comfort around that as an infra investor is, I think, the challenge of the day, right? But it's at the same time, this is the time to participate. There is no, you can of course wait sort of to the next round and the next round, but I think this is where at least we see a lot of investors taking a stand now and saying, well, we believe in the future infrastructure characteristics of these businesses, and therefore we are investing now and supporting management teams that are sort of credible participants and have a credible plan going forward.
Yes, indeed. So in many cases, it's not about a team that's deployed 10,000 charging posts and I'm buying that asset base. It's actually a team that has proven that they can do it, but maybe only done it for a year or two. But that's enough. Nobody's done it for many decades. It's about, has that team set themselves up in the right way and proven that they're able to execute on their plan? And I want to back that team to give me a position in this marketplace. Indeed. Talking of which, we'll turn to Luís, who's one of those teams who's taken on capital from an infrastructure fund. Sorry, Christian, were you going to say one more thing?
No, I think it's also one point that is oftentimes forgotten when talking about sort of utilization risk, right? It's not you are committing hundreds of millions at this very point in time for one investment, but I think you are committing to a longer journey for individual investment decisions that can be adjusted left, right, and center to where the best utilization is. And I think that's part of the journey of getting comfort.
Yes, I fully agree with you. And I think behind the headlines that you sometimes see about deals being announced where so-and-so company has taken on 200-300 million euros from so-and-so investor, oftentimes that investment isn't paid in one go and sitting in the balance sheet of the company, it's tranched. And even if you added up all of those checks from all of those investments into every EV charging company, it wouldn't but scratch the surface of the amount of capital that is going to be needed to develop this ecosystem over the next decade and a half. And we'll come back to that point in a minute. But we'll go back to, I was just going to you, Luís, around I think the point that was made around, by Witold, adjacent revenue streams, right? So as somebody who's just taken on capital from an external, do you see a lot of attention being made so far on your core business of rolling out chargers, or do you see a lot of importance being placed on adjacent revenue streams becoming important, like advertising, for example?
Well, it's a good question. I think that the business model of EV charging must work by itself. So it shouldn't rely on advertising to work. And what we've seen in the market is that people are willing to pay to charge the vehicle. So that's good news, right? So we really believe that focus is key to develop a business from scratch. As you were saying, like investors are backing up management teams, not with a couple of chargers, a little bit more, but still. And still, we are growing a lot in terms of number of chargers being deployed. And what we are very focused on is providing the best experience for EV users. Otherwise, if we start losing our attention and not focusing on what's important, which is to provide the best experience for EV users, it will be much more difficult to create a business from scratch as we are doing. So I think they might be important in the future. But I think companies that are entering the space should focus 100% on the charging experience for EV users, and revenue will come because people are willing to pay for it.
Okay, so if EV charging has to work on its own in your viewpoint, Luís, let me turn now to Wolfgang, who's focusing on the commercial vehicle segment, which some may argue is 2-3 years, some more, some less than perhaps passenger vehicles and light commercial vehicles in terms of EV adoption. In many cases, there aren't even the vehicles available. How do you address this point around EV charging on its own needs to wash its face financially for an investor, given it's still so early?
Well, I mean, let's face it, this is what we're doing, and building up the infrastructure is really bringing an industry to a point that there's a transition towards electrification. And therefore, the main goal that now is in front of us is building up an infrastructure that allows operators to run a truck from the north of Europe to the south of Europe without any big difficulties. And that's the biggest challenge that we have. It's always about customer experience, and then always the coffee comes with it, and it needs to work, and you need to have too much detours or too much waiting in line. What we are doing, waiting, is not an option, because this is about commercial trucks, and they make money in being in time, and they need to be on the road and be able to charge at the point where they need to charge. And it's not an option to change also the user in his behavior. So for now, in our industry, that's a very clear picture. It is about building up that infrastructure to enable a whole industry to transition. And this is also why we are intensively building our activities on partnering, because this cannot be done by one company alone. So we can be the initiator, we can be the ones who started, but it needs to be a whole bunch of more partners in many areas that step up to the plate and that start to really bring this industry into the right point. And I think the big difference probably towards the private vehicle sector is that the TCO is a very important element in our industry. And once we've reached that point, I think we will very quickly see that logistic companies will then switch to buying electric long-haul trucks, because then it just makes more sense for them. And if we are able to bring the industry to that point, at the same point where OEMs are delivering the vehicles, and again, the customer wants it, they're there, they desperately want to have the vehicles, they're waiting for it. I think this is the main purpose right now, getting the infrastructure in place, 100% reliability, because only then we will make this industry start into that transition.
Very good, Wolfgang. I think a lot of the points you've just said will resonate with the audience who may be focused on the passenger or light commercial vehicle too, right? It's the same argument. So I'm going to use the opportunity to go back to you, Luís, and ask you this. Presumably you're still getting questions from your investors or in your recent round around that hockey stick chart that you will have put in your business plan up and to the right of your growth trajectory. And that growth trajectory will come from more charge points, but also increasing throughput on those charge points, more utilization, more charges per day. How are you getting customers, your investors, or how did you get your investors comfortable with the unknown or the current uncertainty about how realistic that plan is? Is it going to be as fast as you've projected? Maybe it's going to be a bit slower? Can you talk a little bit about that journey? Because it's not just unique to the commercial sector.
Yeah, of course. So I think in the last 6 months we had the opportunity to speak with a lot of investors, and I think I can summarize things. We found two different kind of investors, the ones that were just entering the space and where the discussions were more high level, and we saw some more trying to defend and try to discuss how EVs are going to evolve and if they are really the solution or not. And so those discussions were more like, is the industry going to go this way or not? And then we found also investors that were more already very experienced into this space, and where we had the opportunity to discuss really more interesting questions, such as, is going to be home charging or public charging? Is going to be highway charging or I don't know. So these kind of discussions were more interesting for us, and of course we still don't have, of course, all the answers, otherwise we wouldn't be here. But I think the way we could make investors more comfortable with investing in PowerDot was first to develop a well-structured team, because at the end of the day, we are giving the first steps and installing the first hundreds of chargers now, and we want to grow to thousands and thousands of chargers. So only a good team is capable of doing so. So team was very important. Second thing was a little bit aligned with what Witold said, which was long-term deals. So showing that we can commit long-term with the partners that we were partnering up with. And also, these investors that already were very experienced in the space, they were already convinced that the tailwinds were there and the demand was going to be there. So at the end of the day, it's all about execution, and I think team is the key element into entering this space.
Yeah. So I think there was something, I fully agree with what you're saying about the team, but there was another point you made just then, which I think is worth dwelling on. And it links to what I was saying in my opening remarks about EV charging is attracting a new wave of investors that weren't involved in this sector, in our ecosystem, maybe as recently as 3-4 years ago. And their understanding and education on this space represents that new entrance, right? So, for companies like Luís's and others and Wolfgang's, who may have had to explain EV charging basics 101 to investors when they were doing their seed funding and early stage investing, they're now finding themselves having to do the same education and explaining to new investors who are entering to this market for the first time, as they're seeing the appeal and the attractiveness of EV charging. And that represents challenges and opportunities. And it might be that those investors that you speak to it's very clear it's the first time that they're exploring EV charging, the likelihood of them cutting a check and investing is probably not as high as somebody who's now looked at a few opportunities and is more familiar with it. So with that, I'll turn to you, Christian, right, and ask you, as somebody in an advantage point who advises investors both on all sorts of deals in this space. Are there parallels maybe with other industries that that companies or businesses can highlight to investors when they're thinking about moving into EV charging, maybe to short circuit or accelerate that education piece?
Yeah, I think there are a number of industries that are typically coming up, right? There is sort of the comparison to the telco infrastructure side with, towers, but also to fiber partially, right? And I guess those have somewhat similar challenges. I guess the thing to learn that we typically point out is that, of course, whatever, longer term contracts for utilization you can get before building is of course fantastic, right? And I think you see a number of public CPOs in the current investment rounds also doing that much more than maybe at the beginning. I think another one that is typically coming up is, of course, the whole fuel retail part, right? People are asking, so will we see a situation where the only thing we will make money on is the adjacencies, the convenience stores, sort of everything around the charging? And I think, while I at least would believe that parts of the market might work that way, I think there are probably a lot of other segments similar to fuel stations today that work in a different way. So I think those are, I guess, the two main ones that we typically use.
And Witold, thank you, Christian. And Witold, any perspectives that you have as an investor into this space? You've been investing in EV charging for some time now. What parallels or what other industries might you draw parallels with as you're looking at this sector?
So I must confess, I've always been quite bad at this type of comparison exercise. First, because I've always invested in energy transition, renewables, infrastructure, so I don't have a 360 view on many other industries. And then because in our portfolio, we don't really try to compare EV charging to something. I think it's a quite unique object in its risk profile and the way you can do deals. But so really focus on trying to frame the risk profile of the investments. Obviously, utilization is the main one, and nobody can pretend to know exactly where EV drivers will charge in the future. So you can pay consultant to make your adoption curve and make blunt assumptions on the share of public charging and then the subsegments in terms of charger capacity. But in the end, what matters to us is to have a diversified approach in the portfolio. So having a CPO who can address different types of charging behavior. And if we were to invest on a very specific segment, or like ultra-fast charging, you need to have a team who has the agility to question themselves and admit they were wrong if the market is not moving in that direction. You don't want to be sticking to your ultra-fast strategy in all your markets if it's not really suited to the type of EV drivers' behavior. So to have this agile mindset is paramount. And finally, the technical part is extremely important. Apart from maybe home charging, and I'm not sure it's even the case, but it's not just plugging a socket on a wall. There are some technical issues on EV charging. When you look at the statistics and satisfaction surveys, it's quite poor. Like in France, 1 EV driver out of 2 is not satisfied with his charging experience. For one driver, a driver is facing 60% of time an issue while charging his EV, usually due to charger unavailability. So it looks like the infrastructure backbone has to be really improved. And I think we are still in an early phase where it's not yet the mass market or customer acquisition race. Now it's really about building a reliable infrastructure backbone. So having teams who are foot on the ground and who know how to operate an infrastructure that fails is also very important.
Yeah, no, that's great. Thank you. So we've heard that there are some parallels in pockets, but EV charging is also unique and new. And actually, it's about the agility and flexibility of the teams investing in this space to adapt to this market that is most important. We've heard that point a few times today. Let me turn now to perhaps one of the biggest elephants in the room of recent weeks and recent times, certainly in the market where I come from, the UK, which is the impact of rising energy prices on EV charging, and particularly the impact on public charging companies. What are your views on this? Can rising prices that we're seeing at the moment, even if they're short-term, potentially with government intervention to protect them, can these be passed on in full to motorists in EV charging? What else can be done to mitigate the risks of rising prices? Luís.
Well, I think that's the million-dollar question, but it's a new problem. We believe it's going to be a short to mid-term problem, and it needs to be addressed as such. But at the end of the day, I think this will have an impact on users, and as it has an impact on all the companies, not only energy companies, but also everyone is suffering because of energy prices. So I think at the end of the day, we will need to find a strategy as a society to deal with this short to mid-term issue because it will impact everyone.
And thank you, Luís. And Wolfgang, from your perspective, are you starting to see this impact already? Do you think rising prices can be passed through to your customers? Have they got what is described as low elasticity of demand?
Well, I mean, our customers are not yet there because we are just about to build up the infrastructure. Of course, we're talking about, probably next 24 months that we will face the situation. But as especially in our industry, the TCO, really the prices, really the comparison of an ICE and combustion engine truck towards an electrified truck, that's going to be the important element when logistics company actually going to jump and then really going to transition to the EV. To electrification. Of course, prices, especially if of course electricity prices go higher up than the regular fuels, then it's going to be a problem because it's going to push back our TCO flip point further into whatever 1, 2, 3 years. So of course we all hope that this is going to be a transitional effect. Somehow doing some caps in the market, that's going to help at this point, but you cannot develop and expand in a market that is regulated. You can't. It just wouldn't work. So at this point in time, we hope that's a transitional aspect, that we won't have to deal in that volume anymore in 2 to 3 years. But if it would be, then of course it could do some harm to EV transition, yes.
And maybe, Christian, I'll invite you to comment on this point as well, because I know this will be a conversation that's being brought up by many of your clients. Do you see this as or do your clients see this as very much a short-term containable issue? I guess nobody knows the answer to that question. If I had a crystal ball, I would certainly try and find a way to monetize that. But how are they thinking about this? Are they thinking about it short-termist, or are they thinking about it in a different way?
No, I think indeed most of them are sort of looking at it sort of by the day, by the week, and thinking about, okay, how are we going to deal with it going forward? And that's not only true for the EV charging industry, right? But I had a discussion with a sort of paper producer the other day. I think it's the same situation, that everyone is trying to understand, okay, how do we best position ourselves with these price levels and the forwards looking like that, also in sort of versus competition. And I think when we look at charging, of course, one big question is, how much do we want to pass this on to customers, in the sense of, destroying almost our own demand. I think the other question is, will at some point somebody in these markets, that has a dominant position, actually see this as an opportunity to crowd out some of the smaller players that maybe don't have those deep pockets, right? And I think that this situation creates opportunities for that. And I guess so far we haven't seen that really, but I think, of course, these extreme dynamics are facilitating those type of dynamics in a young market like this.
Yeah, I think that's incredibly well put. Thank you, Christian. So I will now ask our organisers if there have been any questions submitted by the audience, and maybe we'll turn to those if there are any questions coming through. Here we go. Here we are from Goran. What are the biggest risks when investing into EV charging infrastructure from an investor point of view? Who'd like to take the first one? Maybe Witold?
Yeah. It's not an easy one because you have many of them. And it depends on the conviction you have beforehand. Like, the biggest risk I see may not be the biggest risk someone who has not invested in an EV charging network before see. So it really depends from where you stand and what's your experience and about the space. But obviously, charging behavior to me is the biggest. It's not necessarily scary. Like again, if you have the ability to adjust your strategy and you can have a diversified network that address different type of charging behaviors. It's fine, but it's probably the biggest. And then I think on the long term, independent CPOs will face competition from integrated players who control their energy cost. The big guys, the oil and gas, has not really been full speed yet on EV charging, depending on which market you are talking about. And they are sitting on a strong balance sheet and a lot of cash that has not poured really into the market yet. So I would say that for independent CPOs is also to get more sophisticated about electricity sourcing. Of course, you need to reach critical size to do so, to start negotiating PPAs or have hedging strategies. But this is not to be neglected. It's the main input for a CPO, and you can just not be imposed your main input cost. So,
I think that's entirely consistent with what I've heard a couple of other investors tell us in recent weeks, is that the energy crisis that we're seeing at the moment that's translating into higher prices, even though everyone is convinced that this is not a long-term challenge for this industry and margins can be maintained, it highlights that that's a risk that hadn't really occurred to them, that actually there could be spikes in wholesale energy prices for public CPOs that are a potential risk to them in the future that needs to be mitigated through some of the strategies that you just outlined. Christian, do you want to comment?
Yeah, it also highlights again the importance of energy management capabilities for most of these players, right? Which I think is something that not everyone has focused on so far. But I think in addition, the biggest risk, I still think a lot of investors are still very worried about sort of the disruption risk around the technology. At least when they come in, is hydrogen going to be a big thing? Are we going to see battery swapping? I think those questions are still there. I think with more mature investors, they are typically off the table. But I think that is probably still the biggest risk that some investment committees are fearing.
So we've heard a few times from the panel today that actually it's the team's ability to execute, it's the individuals that have been assembled, the team that our investors are often backing. And now we're saying that there's a new theme or a new area that's emerging that's relatively new, which is the art of energy management and thinking forward ahead, what could the impact of that be? So maybe if you're a CPO out there or an EV charging business and you're thinking about your team or gaps in your team, this is a new space to bolster the ranks so that you can preempt and anticipate those questions from investors if you haven't already started to think about it. We have the next question, if there is one, please. Thank you, Ollie. Do you see destination charging as an investable case, even an aggregating platform of these destination charges? Maybe, Luís, you want to take this? You're in destination charging.
Yeah, exactly. So we are strong believers of destination charging, and we build PowerDot around destination charging. So I think our answer to this question is yes. The reason why we believe destination charging is very interesting is if you think about as a user, you want to make sure that the charging experience is somehow embedded in your life, because this technology allows you to do so. If you can install chargers everywhere you go, and if you find a charger everywhere you park your car, basically you don't have to do a detour from your life in order to charge your vehicle. So this experience is even better than owning an IC vehicle, right? Because you don't need to go to a gas station to fill up your gas tank, right? So destination becomes very interesting because it allows users to have a better experience. And that's why we are so bullish on this type of charging.
Yeah, and even an aggregating platform of these destination chargers. So the opportunity in the market for a platform that can, I guess, help customers identify where those destination chargers are. If every destination has a charger, is there a business for aggregation? Maybe Christian.
I guess it's probably something that a lot of aggregation businesses share, is that they have a place to play if they really add customer value, right? I think it's similar to a lot of the MSP plays. I think there was a lot of discussion already today whether there is room for MSPs, whether the ad hoc payment mechanisms will not take that away. But I think there are a number of examples where companies, aggregators that just make life more convenient for users are also able to charge that premium that they require to live off. And I think that's, I would argue, is the same here. So if you find something that's great for consumers, I think there are still so many pain points out there that need to be solved. You have a case.
Fantastic, thank you. We'll have the next question, please. Okay. So thank you, Dr. Ing. So e-mobility is highly dependent on the TCO, especially for the commercial sector. However, this morning we learned that e-mobility currently is more expensive than the gasoline model. What's your view on that, and how do we best address this? So I guess this is from another study that's come out that says if you fill up your vehicle with electricity from public charging on a mile per mile basis, it's more expensive than if you fill it up with gas. Who'd like to take that one?
Well, I can start. I think the TCO is a short-term problem because what this industry needs is scale. It needs scale on production, scale on creating EV charging infrastructure, scale on everything. So we need to start somewhere. And of course, that it's very unfair to compare the TCO today and the TCO in 5 years from now. We are just starting. And I think this is going to evolve. You see OEMs creating cars that are cheaper and cheaper. You see CPOs such as PowerDot becoming bigger and more efficient in managing charging infrastructure. So what's going to happen, this will bring the prices down and the TCO down. And what we can see today is that today is possible to see a TCO lower than IC vehicles, and that's why we believe in this technology and why we believe that EVs are going to replace IC vehicles. So I wouldn't worry too much about the current situation. Maybe it would delay things a little bit, but it wouldn't. It's not like a structural problem.
Yeah.
Yeah, I mean, there's so much, research going into new technologies, batteries, ranges, everything, that I think the TCO element that we will get to the point where we get to parity, and of course electricity prices, that might be a bit of a problem there. But I think the only answer to that is just reduce it.
Yeah. So I agree with both of you. The nascency of this market suggests that we all know it's not at scale yet, so scale will bring economies that will bring prices down. Compounding that is the short-term energy price hike that might be driving the study that's being referred to here, as well as I haven't seen that study, but there are a number of these that have come out in the last few weeks that have made similar claims. But if you pick under the covers, if you're charging in the majority of your time using a slow charger, whether it's at your home or place of work, and topping up occasionally with public charging, you get to a very different outcome than if you're using public charging for all of your charging needs. And I think that plays very much to what a lot of commentators in the industry see as public charging doesn't necessarily compete with residential charging. They complement each other. And it's very unlikely that you will always use just one for absolutely 100% of all of your needs. So I think it's still early to jump to conclusions from some of these studies.
I think there's of course one important element in this. TCO is just one important driver of purchasing decisions, right? I think in commercial vehicles is a lot about the license to operate. For city centers to be able to go in, you need an electric vehicle. And I think the same holds true then on the passenger car side. People are buying EVs also because they fear that their ICE vehicle is going to be worthless in the future, right? And that's rather the future TCO determining that than today's TCO. So I think today's TCO are important, but just one driver in the equation.
Thank you. Okay. And do we have another question from the audience, please? Okay. How do you manage predictability of income streams given uncertainty around volumes, development of unit margin, availability of greenhouse gas quotas? So this is very much a question around the themes that we've been discussing today. The predictability of revenues around the uncertainty of all of these inputs. Who'd like to have a go at answering that? I'll pick on you if we don't have a volunteer. It's a very loaded question. Okay, Luís, I saw you bring the microphone to your mouth, so you get first.
It's a difficult one. I was trying to avoid to answer this question, but of course that our business depends on demand. There's demand risk associated to our business because we depend on people to use the chargers at the end of the day. There are a lot of ways to make sure that the locations where we invest and the charging infrastructure that we build have stable cash flows, generate stable cash flows, and stable utilization, and we can prove this with data. But I think as an investor, because we are also investors because we invest in infrastructure, we need to learn how to deal with this new industry, which is EV charging, right? I think companies that's starting to build highways in the 80s or 90s, they had to deal with the same kind of issue, which was to deal with volumes and how can I predict my volumes and etc. So I think it's about it's a problem that we can solve with data, and to have more data and better data, we need to wait more time, to give a little bit more time to the industry to develop itself. But what I can tell you for sure is that the yearly numbers are pretty good, and otherwise there wouldn't be a lot of CPOs raising money out there and a lot of infrastructure being built out there. So it's a challenge, and only time will be able to give everyone more confidence to enter the space.
Well, thank you, Luís. That's a perfect segue to my final question to wrap up our panel, because I see we only have a few minutes left. And thank you for answering that rather multi-layered question in one go. So this I'm going to ask each of you just to give a very short, quick answer to as part of the wrap-up. So some commentators are suggesting that EV charging is already a crowded market, with lots of players all competing for similar pools of capital. How do you expect the continued expansion might be funded? Do you think it's going to be more of the same, or new investors coming in, from different asset classes, different pools of capital. What's your view on all of this? Maybe we'll start with Christian and work our way down the panel.
Short answer.
Yeah, short answer.
So I guess my impression, no shortage of capital. I think the ones that are in the market today, the core plus, the private equity, the more and more core investors as well. But I think there's also all the location owners opening up to investing themselves because they see there's a business emerging and they understand the economics of that location very well. So I think it's not a shortage of capital in that sense. And of course, a lot of money needed, but a lot of people willing to invest as well.
I can't more than agree, because what we have seen in the past 2 months since the company is existent, talking to partners in whatever area, these partners, they are eager to partner and to support, but they also want to invest. They want to be part of that, and not just in sending invoices and building up sites, but there is also this momentum that they want to be part of investing in that infrastructure, and that opens up an additional bucket of money that, of course, helps in raising money in other areas. And of course, governmental funding mechanisms will play an important role, especially in our areas, in the commercial and the trucking area. So I agree that there is enough capital out there, and it's getting braver, broader, and more diversified, which is good.
So me neither. I'm not particularly worried about shortage of capital. I think capital is abundant, and it's quite crazy to see the amount of investors fighting for the same players in some markets where, after a first wave of consolidation, you just have 1 or 2 pure players who are actually leaders in the market, but they are just 2. So if you miss them, then you wait maybe 3 or 4 years to invest in the next generation of company. So there's a lot of appetite. I think additional funding, I think when debt kicks in, it will accelerate the market massively. It will free up mechanically 60-70% of the capital requirement to deploy further networks. We've seen also the first SPACs, and also now the hype has faded out. But the public markets at some point will also get comfortable with EV players like CPOs. And then obviously the large infrastructure funds, because for the time being it remains a bit under the radar. It's mostly mid-market players or funds that make an exception to the investment policy to try and invest a bit earlier stage. But then you have extremely abundant capital, and then I think the last layer, when the market is really mature, maybe 10 years down the line, it will be institutional money and pension funds. Assuming the asset class develops like other infrastructure asset classes.
Thank you. And Luís?
Well, I don't want to attract more competitors to my space, but I think that we are investing in this sector is going to be key, and to have more players in this sector is going to be key to develop an interesting network for EV users to have the confidence to change, or future EV users to have the confidence to change to and buy an EV. So I think we are still just scratching the surface, as you were saying before, and more investment is required in the space.
So there you have it, ladies and gentlemen, from our esteemed panel. Utmost confidence and optimism about the capital inflows into our ecosystem in e-mobility. I'd like to thank you. I'd like to invite you all to join me in thanking our panelists for today for their great responses and considered answers to our questions, and also to the organisers once again for bringing the whole community together here in Berlin. Thank you, everybody.